Welcome to today's session. Let's get underway here. For the time being, we're going to go ahead and I'm going to utilize these trainings each Tuesday, Thursday in a recording format. So they'll be ready for you by 2 o'clock Eastern time, noon Mountain time, and a similar format that we've gone through in the past. We're just finding that the live sessions are just not getting a little bit tougher for people to be able to attend, and a lot of times the recordings work out really nicely as well because you can skip through things and get to the areas and the content that you primarily want to utilize. And so we're going to go forward with this for the time being and see how that works out for you. Let's jump in here with market conditions, direction alerts. We're still sitting at bullish in a bull market. Bull market rank is sitting at 25.56. We've been working on this overall uptrend now, and looking at the momentum, the 1 year time frame. We'll just do a little bit of a recap here. Remember that the momentum indicator up here, this 1 year time frame, is just that. It's 1 year, whereas this bottom one is 20 years of the S&P 500. So we're basically just looking at, and this is about 2 years worth of time on this uptrend right here. This goes back to last year, October, and you can see that this range here at 11, and we're all the way up in this 25 range. So we know that we're in the stratosphere on this current trend, and part of the adjustments that we're utilizing in where we're at in the current market condition is position size. How big of a portfolio do we have? What percentage of equities are we holding versus cash? And typically we're going from equities to cash in terms of the allocation. We're not going to focus on a little bit of stocks and a little bit of bonds and a little bit of cash and a little bit of bond, this, that, or the other. We're just going to focus on equities and cash. Now, in that equities portion, we can utilize ETFs, which can include commodities, like USO or GLD for gold and USO for oil. So we can include those as well as, maybe those pieces of the portfolio that you still want to be allocated to. But And also along those lines, we're utilizing everything that we talk about and go over. If we're not talking about a stock, we're talking about an ETF, so that anything that we go over is tradable in a very simple brokerage account. You don't have to have a futures account. You don't have to have anything fancy. You can just simply manage these in long positions only. And that's the other thing, is we can utilize inverse ETFs for anything that we may want to participate in on the downside or in a bearish trend. We can utilize inverse ETFs on the long side, meaning that if something is going down, if the S&P 500 is going down, we can have an inverse ETF, which actually increases in value, goes up in value. And we can review some of those things as well. But as you're going through and starting out, and remember that TradersPro, the entire setup is designed as a system. You want to start off with the market trends. You want to start off with, what are we looking at? What's the big picture telling us? And that's this initial chart here. This big picture is we're in an uptrend. We know that. We also know that we're extended into this uptrend. We can obviously see that in the chart. And historically, stocks just don't go up forever. Markets they are designed, stocks are designed to go up in value over time because the underlying companies are designed to grow. They're designed to be profitable. When they don't, then the stock price goes down as well. So by and large, the S&P 500, the S&P 500 of now is not the same S&P 500 of 10 years ago, and not the S&P 500 of 20 years ago, because they add in new stocks into the S&P 500 and get rid of other stocks that are laggards or maybe not relevant. So the S&P 500 is always going to have this upward trajectory, say that 10 times, and because a lot of the stocks that go away get replaced, and so this indicator is going to continually be moving to the upside, or the stock market is going to be moving to the upside as well. Now, we obviously are going to have shorter term panics and shorter term scenarios that do retrace all stocks, but in the vast majority of opportunities or scenarios, those are buying opportunities, and that's really the approach that we're using. Obviously, you can do a lot of additional things to that. You can go short, you can buy options, you can have lots of different things, but that's not what we're focused on. We're focused on primarily on buying stocks long, meaning meaning buying stocks and owning them as they go up. But we're not holding them forever. We're going to trade in and out of those stocks as they lose momentum, as they lose a little bit of steam here. And so we'll get into that. That's really the basic of the overall approach that we're focused on. Now, in the shorter term, we want to also focus on where are we at in this trend. We want to see momentum. We want to see breadth, which is essentially the number of stocks participating in the rally. And then we also want to see sentiment. Sentiment is what are investors thinking of the market. And oftentimes when everybody's on one side, that's an area where, again, we're dealing with supply and demand. When everybody is bullish, then there's no demand left. There's nobody left to buy. And at some point when selling starts happening, then we get selling creating the supply. And if there's no demand there to buy it, then we get downtrends. And so we're still dealing with, ultimately, the stock market is just a giant auction. It's nothing more than an auction of buyers and sellers. And when those buyers and sellers load up or unload in certain areas, it's a supply area and a demand area. And ultimately, we want to be in those demand areas as stocks are moving higher the vast majority of the time. So current market conditions, we're looking at shorter term, we are seeing momentum moving to that upper range. We're seeing not quite extreme quite yet. And indicators, on an individual stock, we may see this extreme pretty quickly. On an indicator or on a market as a whole, we don't see that quite as often just because it's a larger group of stocks. It's that aircraft carrier trying to turn the corner. It takes some time for that to happen, and we don't necessarily see these really sharp, extreme moves, particularly in S&P 500. Although we do see that, and that can happen. It just doesn't happen a lot. We're in that range right now. We're also in a positive trending momentum with breadth. That means that the vast majority of stocks are in uptrends, and the vast majority of stocks in uptrends means the market's going to be in an uptrend most of the time. And then sentiment, we're seeing we have just a lot of complacency. Everybody's still bullish right here, and that's good for the market conditions that we're in. It's going to shift at some point as well. Let's jump over and look at the buy-sell ratio, because we are seeing that starting to pull back a little bit, starting to come closer together. The number that we want to focus on is right down here as well, and that number currently is right at 1.5. So that's starting to weaken. We had topped out here about 4 during that last rally. So as the market is starting to drift a little bit higher, you're starting to see selling in some of these uptrends that we're getting. That also is going to warrant a little bit of caution at these levels. The other longer term perspective that we always want to be aware of, and that is the bond yield curve. The bond yield curve and bonds and interest rates ultimately, and it's debatable, but it ultimately controls what the direction of the market is doing. Because if you think about what interest rates are doing, they are it's either easy money, it's either easy to borrow money, cheap to borrow money, and when companies do that and consumers do that, we borrow that money cheaply and then we go spend it in the economy. Companies borrow that money cheaply and then they go grow their companies, or whatever it is that they're trying to do. It creates and stimulates additional growth when we have lower interest rates, when we have a healthy bond yield curve. A healthy bond yield curve means that the short end of this yield curve, the short end here is 3 months, the long end is 30 years. When we have short-term interest rates really low, that means borrowing costs in the short end of that yield curve are attractive, and people are going to want to go borrow money, which that borrowing money creates leverage in the economy. Okay, when we go spend that money, and it has a ripple effect to the upside, and it creates growth in the economy. Well, when there's too much money in the system, it creates inflation, and so we get prices going up so high, and that's a scenario that's caused some problems here recently that we've been dealing with. And when that happens, the Federal Reserve will raise interest rates to slow down the growth of the economy. And when that starts to happen, we get a bond yield curve that inverts. The short end of the yield curve gets higher, meaning that short-term interest rates are higher, and we're having to pay a lot more money for borrowing money. Therefore, it's a deterrent for us as consumers as well as companies. We don't want to borrow as much money. We maybe will think twice about refinancing our home. We'll think twice about getting another credit card or buying that new car or whatever the scenario is, we think twice because the cost of borrowing is so much higher than it was way back here. And that's on purpose because we get inflation, meaning the prices of goods and services are going higher, and they're going higher too fast to be sustainable, and it creates issues. If you've been in the grocery store lately, and and I have a lot. I've got 6 kids, and so food is expensive, gas is expensive, and all of these things are expensive, and that's a problem going forward. And so the Federal Reserve has been lowering interest rates, where they just barely did, in order now to slow that down, to stop the inflation. And the game that they're always playing is, are they going to break the economy in order to slow inflation? They typically do, and that's some of the terms you may be hearing, like soft landing. It's, did we get enough slowdown in the economy without breaking it with higher interest rates? So now what we want to see is, we want to see this yield curve start to come back down again. And typically that doesn't happen. If we go back here to 2000, here's an inverted or a higher yield curve on the front end of the yield curve versus the long end, and this blue line is the stock market, is the S&P 500. Well, as it's going down, look and see what's happening to the bond yield curve. Okay, stocks are anticipating slower growth, or they're getting data, economic data, that is also slowing. And so stocks are moving lower. So typically it takes a stock market retracement in addition to interest rates moving lower, to get a healthy bond yield curve. Now we're back in that scenario. It moves higher. We get an inverted yield curve, or a disproportion of those rates moving higher on the short end, and then we end up with a healthy yield curve here. Now, this is 2009, and as we were moving higher, and we moved up higher, we ran into COVID right here. Okay, so COVID created a situation where we had basically zero interest rates across the board. Even the 10-year, 20-year, 30-year were less than 2%, okay, even less than 1% to borrow money. Well, what did that do? If money is cheap or free and we can borrow all the money in the world and go spend it, it creates inflation. Okay, so that's the scenario that created the inflation. And now we're in a scenario that we're trying to stop the inflation by doing this. Okay, we move forward. Now we're getting a retracement. Now watch this yield curve right here in this last 2 years. Okay, it's spiking higher. Now this is where we're at right now. Okay, you can see they're starting to come down a little bit. Okay, let's move that. You can see that short end is now starting to come down. That's what we want to see. But we also want to be aware that a lot of times it doesn't come down. It can start to come down, but stocks typically go with it. So we're in this area where it's kind of this, they call it maybe a Goldilocks scenario, not too hot, not too cold, it's just right. The Fed does a pathetic job with that. I mean, they always overshoot one way or the other. In this case, typically, it may be different. It's typically not any different, but we want to be aware of what the interest rates are doing, because it has a major effect on stock prices and the overall economy as well. That's the really big picture. So anything under this market trend tab is the big picture. And then from there, we can narrow in and try to create some strategies. What percentage do we want to be in stocks right here, knowing we've had a nice uptrend, knowing that interest rates are starting to come back down? Now the issue is going to be economic numbers going forward. You'll see less interest on the Fed cuts, and you'll see more interest on what are economic numbers, what are employment numbers. All of these different things are going to start to play an effect on the stock market. Now, from here, let's take a look at kind of the current market conditions. So in terms of that, based on where we're at, you've got to decide what your allocation is. Mine currently is about 25% in equities and the rest in cash. So it's pretty heavily weighted towards cash right now. And then the allocation on individual stocks is about 2% per new purchase. So as I'm adding a new stock into the portfolio, then it's about 2% of the overall cash or the overall portfolio as a whole. So still pretty conservative, because we're going to have some winners, we're going to have some losers. Okay, current we're up about 20% on some, 6, 7, 8%, 2, 3% on some losers, get stopped out, get some winners, take some gains. That's the rotation, the wheel process that we're utilizing of managing our perspective of this. Where do we think or where do we anticipate markets are going from there? We don't always want to just be, hey, we're going to buy stocks and hold on to them. You can certainly do that, and long term, that's probably going to be just fine. But in the shorter term, you may need your money. You may not want to deal with volatility and risk by just buying and holding something, as well as buying stocks. You may decide, hey, I don't want any stocks right now because the volatility is hurting me, the volatility is scaring me, the volatility is creating additional risk that I don't need to have, because I can sit in cash right now for what? I can sit in cash right now for 4.5%, 5%. Okay, at some point that's going to start to get low enough that it's like, gosh, I don't want to be in cash. I'd rather be in something that's going to do something a little bit better longer term. But one of the factors, and this is called suitability. Suitability is what is suitable for your current financial circumstances, and stocks are not always suitable in certain circumstances for certain investors and certain traders. Okay, now with trading, what we're focused on is we want to have this perspective of how much in cash, how much in stocks. Now, from there, what do? Which stocks do we want to own inside of that portfolio? And so we utilize these muscle stocks and these new buys. So what we're focused on primarily is we're focused on momentum stocks. Momentum stocks are already moving higher. Okay, they're already in uptrends, and we can utilize two different things on these charts. We can utilize the rank, we can utilize the trend, and then we can utilize the Fibonacci ratios. Okay, or these are supply-demand zones. Essentially, these are just core locations that activity starts to happen. Buyers and sellers are stepping in, or they're looking for things to happen. We utilize this location for a line in the sand to cut losses. Okay, to say it should, if it's green means it's in momentum. Yellow means it's pausing that momentum and potentially shifting momentum back to red. So we primarily want to own something that's in momentum and continuing momentum, because again, what we're focused on are stocks that just do this. We're not looking at selling and then buying and then selling and then buying and then selling and then buying on a stock. That can happen, but we're just focused on a company and a stock that are continuing to go higher, because we want the underlying idea behind that. In fact, let's look at this here. There's a good example of that on, we can look at this one. That's gold. Okay, a gold stock. Gold is moving higher. Gold stocks are going to participate in that uptrend. We want to play that theme. We want to focus on that theme. The one I was aiming for was this one here. Okay, LUMN. This is a network technology. I believe it used to be CenturyLink. So they have massive fiber and massive infrastructure for delivering data. Network, across the U.S. I don't know all of the demographics on it, but it's the idea that stocks, some companies are going to be doing really amazing, like Nvidia recently, like this stock, like most tech stocks. They're going higher. Amazon, Microsoft, Google, those stocks are continually moving higher because they have super cool products and their companies are great and they're making money over time. Well, we want to try and get a little bit maybe more octane, higher octane on some of these stocks. And so, but we're looking for that idea more as it's moving higher. And then we want to be able to trade those as they're moving higher. And at some point, we're going to be selling some of those positions moving higher. And at some point, we're going to say, this is not moving my direction. I'm not going to wait around to see where it bottoms out. Okay, I need to get out of that stock, and that's called a stop loss. Okay, our stop loss allows us to maintain a risk profile so that we're always protecting our capital. We never want to, we always want to have a stop loss in place, because we never know what scenario is going to happen. In fact, we've got one today that's in there. I think I might have sold it out already. I don't think it was. OSCR is one of them. Okay, OSCR is going to be getting stopped out today. And you can see that stop location is about where this trend profile starts to change as well. And so it may bounce and it may hold up, but we don't want to wait around and see if it's turning into this and ultimately in a downtrend. We want to determine we're going to get out of a stock, we're going to buy it and hold it as long as it's going higher. Once it stops going higher, and that's what we're utilizing the software for, is to help us determine at what point we are managing. It just creates some structure so that we're focused on this upper range, and anything below that, typically we're utilizing that for risk management. I need to stop out of that trade because it's starting to move lower. I don't know why. I don't care why it's moving lower, and I need to get out of that because now it's going to cost me some money. And we'll buy into those stocks each day. And there's opportunities all the time. Market conditions are always changing, and typically when stocks, when the market's going higher, other stocks are going higher. When the markets are going lower, even good stocks will go higher. I'll always say there's no such thing as a good stock. All stocks are risky. Okay, there's no such thing as a safe stock. Any stock could obliterate your portfolio. And so thinking that way is not a good idea. You always want to be aware that any stock at any time can drop significantly. I don't care if it's Walmart. I don't care if it's, General Electric or, something that you might think is something safe. They're going to be volatile. Now, are they going to drop to zero? Typically, no. But they can drop by half, and you can get a lot of volatility in those stocks. Now, from there, we focus on a stock that's moving in an uptrend. Okay, so let's say we're looking at something like this today. This was the new stock that we added into our wheel portfolio today. And inside of our Discord channel is where we actually talk about the management of the portfolio, buying individual. Which stock are we going to focus on today? How many shares are we going to be buying today? Where's our stop loss? Okay, what are we going to be doing if that moves higher, if it moves lower? So in this case, so far, it's a nice trade right out of the gate. That doesn't always happen. Sometimes it does. Okay, but in this case, the entry on this, if we were to move this over back to yesterday, this is the analysis that we're looking at as of the market open. And this is an end of day system. So we're focused on the end of the day, or what I prefer is first thing in the morning, to go in to look to see which stocks are showing up in scans, which ones am I interested in buying today. And in this case, you've got a new buy signal, increased volume above the momentum zone. And so now we can set up, we've got to, at some point, we've got to make a decision. Say, is this a stock I want to buy? Well, if so, then why am I buying it? And what are the criteria that I'm buying it? And at what point do I need to get out of the stock if it's going to reverse? So here we can set this up and say, how many shares am I going to be buying? Okay, typically, if we're looking at this number down here, the portfolio at risk, this is 1.68. If my number is 2 to 2.5, then obviously I can buy more shares. If I go up to 250 shares, that's 210. That's maybe a little bit high for where I want to focus. Let's go with 2%. That's 240 shares. Now, the position size is 2,300. If I want to now, notice that is the stop price I don't have filled. This tells me what is my position size at risk. The reason why we want this number to be around this, and obviously your trading plan was going to determine if you're higher or lower than that. If you want to have more than that, great. If you want to have less than that, great. Just make sure that inside of your trading plan, you're focused on that number. 2% market conditions right now allow us to still continue to invest in these stocks, but not big percentages. Our risk is relatively small at these levels. Now, from here, we want to set a stop loss at an area that if the stock gets to that area, more than likely something is happening with that trend, and we want to get out of it. And oftentimes it's the most recent low of the hold signal before it's gone to buy, or underneath this 236. Okay, so in this case, if we were to look underneath these lows right here, that you can see that 236 number is 837. If I go a little bit lower than that, this low right here is at 818. Okay, so I actually set the stop this morning at $8. So let's go ahead and add this in at $8. Stop price at 8. That puts us at 0.36. Okay, that's too high for the trading plan. We set it at 0.30, and I actually am preferring 0.20 or less. So to keep my stop at $8, I have to adjust the number of shares. So I've got to come down on shares. If I go to 220, that's 0.33. That's still too high. Let's go all the way down to 200. That's 0.30, still too high. Let's go 180. Okay, 0.7, that's still too high. 170. Okay, now I'm getting into a range that I can say that is, oh, you know what? That actually, that's because I'm like, this is pulling in the current value as of right now. I want this number to be 0.25 because this is where we were at this morning. Okay, not as of right now. So that changes it. Okay, so 1.8. I was like, man, wait a second, that's not right. So 200 shares puts us at 0.2, and if I get rid of the stop now, let's see what that does to our position size. That's 1.5. So it's a little bit small, and that's okay. Okay, we're focused on this number with a stop loss and the entire structure. So if this is my parameter and I'm saying I'm going to buy this stock now at the market open price, I have a stop loss at $8, and my overall percentage of the trading account or the transaction is 1,800, or about 1.8% of my overall portfolio. That's fine. That's great. I'm inside of all of my rules. Now let's pull the trigger, go set up the trade, and then follow it each day. Go in and check and watch to see, am I close to my stop? Obviously, inside your brokerage account, you're going to have a stop loss established as well, so that if and when it gets to that, it'll automatically happen for you, so you don't have to be watching. It'll just trigger, so that you're always protected with that stop loss inside of your brokerage account as that stock moves higher. Okay, so we had an up day so far today. We give it a few days, and we're going to up that stop loss. Okay, maybe it goes higher and higher and higher and higher and higher. This is going to drag with it, and so is that 236 going to drag higher. So we're updating our stop. That's called a trailing stop. We're moving the stop loss higher as the stock goes higher. At some point, it's going to come back, and we're going to get stopped out of that trade, and we're out of that trade. And it may turn into something like this right here. Okay, it may retrace. It may give us another opportunity, but as of this, we don't want to wait it out. And that's where a lot of traders and investors get frustrated. Is it's like, gosh, now I got to wait, or now I've got to sell at a bigger loss. Make sure you always have that initial trade structure set up in place so that you are comfortable with the risk that you are taking. I'm going to end on that note, and I appreciate everyone's time and effort, and we'll see you next time. Thanks a lot. Bye now.